Which is the better fintech stock to buy right now, PayPal or Block? That's a question I've been getting asked a lot lately, and I'm going to answer in this video by comparing the two fintech stocks.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
Of course, both PayPal and Block are stocks that I've been recommending as buys all year long. All throughout 2023, I've had PayPal and Block stock rated as a buy. So in this video, I'll answer which one I think is a better stock to buy if you had to pick between these two. So let's get started comparing these two companies, starting with comparing them on their gross profit. The reason I start with gross profit here and not revenue is because of the interesting way that Block, or formerly known as Square, accounts for transactions in Bitcoin. Users of Cash App can buy and sell Bitcoin, and the way Cash App recognizes that makes revenue not as informative as looking at gross profit, because that excludes those transaction uniqueness of those buys and sells of Bitcoin. So that's why for Block, looking at gross profit is a more informative metric. And to keep things on equal footing, I looked at PayPal's gross profit as well. And looking at this metric, you can see PayPal at 13.7 billion in gross profit, while Block at 7.139 billion in gross profit. Both are growing their gross profit over the last 5 years. Block is growing faster than PayPal. Another thing I like to look at when comparing these two growth stocks is average shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. And with that being said, you can see that PayPal has been reducing its share count, reducing by buying back its shares. In fact, management recently said that they're going to buy up to $5 billion of stock back in the current year because they're generating strong cash flow and they're using that cash to buy back stock. Block, meanwhile, has increased its shares outstanding from roughly 400 million in 2019 all the way up to 611 million. So a roughly 50% increase in shares outstanding. All else being equal, it's more desirable to have an investment that's reducing shares outstanding. The next thing I wanted to look at is cash flow from operations, and PayPal does have better cash flow from operations than Block at 3.8 billion, almost 4 times more than Block at 944 million. Although a concern with PayPal is that the cash flow from operations is trending downward, while Block has kind of cratered and it looks like it's rebounding back upward. No clear upward trend for Block either, but at least we're not seeing the downward trend that we're seeing with PayPal. Nevertheless, PayPal has more than, or roughly 4 times, the cash flow from operations compared to Block. The next thing I want to look at is total assets. And what I look for in total assets is the relationship of total assets to revenue, or total assets to cash flow, or total assets to profit. I'm looking at how much assets it takes for these companies to generate revenue, cash flow, and profitability. All else being equal, I prefer companies to be able to generate more profits, more cash flow, more sales from a smaller asset base. That shows me that the assets that they're investing in, the assets that they're creating, the platforms, the business, the infrastructure is generating a good return on investment, right? That's what it demonstrates to me. The things that you're investing in, the things that you're creating are bringing back a good return on investment. That's what I'm looking for. So PayPal, total assets 76 billion, and that has grown substantially from roughly 45 billion in 2019. Block as well, total assets have grown substantially from a little over 2 billion all the way up to 32 billion in the most recent update. So they're both increasing total assets, which is a bit concerning to me because the pace of total asset growth for these two companies has not kept pace with the growth in cash flow from operations or other metrics. The next thing I want to look at is total employees, and I'm looking at the same thing here with total employees as I was looking at with total assets. All else being equal, I want to see companies generate more profit, more revenue, more cash flow from fewer employees. It demonstrates to me they're able to generate strong profitability or strong productivity from each employee. Okay, and looking at this metric, PayPal has more than twice the number of employees at 29,900 compared to 12,400 for Block. However, PayPal is reducing its employee count, right? You can see the downward move here, while Block is increasing its employee count substantially. Also, in their latest quarterly call, PayPal introduced its newest CEO, a new CEO, and the new CEO kind of hinted at, or it sounded to me like the new CEO was hinting at job cuts coming soon, cost cuts coming soon, and that could mean PayPal reducing its employee count. The management, the CEO saying that he thinks there's room to improve productivity by streamlining operations, and he doesn't think that reducing employee count is going to hurt the businesses in any way. In other words, it's just going to improve efficiency, improve effectiveness, which makes sense. A lot of times when a new CEO comes in, it's easier for that new CEO to institute layoffs or mass cost cuts, mass job cuts, because that new CEO doesn't have relationships with the previous team. Whereas a CEO that's been there for 6, 7, 10 years might have built relationships with the existing staff, the existing team members, and might be reluctant to lay them off, to fire them as he's built relationship or as she's built relationships with those individuals. So this is something I'm paying close attention to with PayPal. The next thing I want to highlight is operating income over the trailing 12 months. And looking at this metric, PayPal again demonstrates a clear advantage here with operating income jumping from around 2.5 billion in 2019 all the way up to 4.8 billion in the most recent update. Management again forecasting strong 20% earnings per share growth for the full year. Profitability still doing well for PayPal, even though cash flow from operations was not doing well. Block here showing a downward trend in operating income, negative 274 million in the most recent quarter. And if you look back, we're not seeing any demonstration of growth in operating profitability from Block. In fact, we're seeing a downward trend. It started relatively flat and it's moved downward in the recent couple of years. Undoubtedly, one cause of that, we saw that significant increase in employee count that could be working to reduce the company's profitability, and it's still in growth mode. The company is growing faster than PayPal is growing, and so it requires greater investment than PayPal, which is now reaping the benefits of investments it's made years ago. And finally, I wanted to compare these two on valuation. I wanted to see how expensive these stocks are compared to each other, and I chose to use the forward price to earnings ratio And according to this metric, Block is more than twice as expensive as PayPal, trading at a forward price to earnings of 21.8 compared to PayPal trading at a forward PE of 10.45. And so, looking at the financial metrics up until this point, I didn't see a clear advantage for Block. Even though its growth prospects are better than PayPal, the Cash App is doing phenomenally well, and so prospects for growth are better for Square, or Block, I should say. But I don't think that is enough to justify a more than 2x premium to PayPal. I didn't see enough with growth in their profitability with the growth in the gross profit. I didn't see enough demonstration in growth in the cash flow from operations. And so I didn't see a good follow through with the growth in the top line, with the growth in the gross profit, leading to other financial metrics in growth. So Block is an excellent company. I do recommend Block stock as a buy. But if I had to pick between Block and PayPal, I would pick PayPal. PayPal would be my choice for the best stock to buy between these two. If you enjoyed this video and you want more free content just like this one, you will want to subscribe to my channel. I cannot overstate how important it is for you to subscribe. With just a click of a button, you can help the production of more free financial analysis for you to enjoy.